Assalamualaikum and hi everyone. Welcome to my channel. I am Madam Yusnaliza. In today's session, we are going to learn how to prepare the consolidated statement of profit or loss and other comprehensive income, and also a consolidated statement of changes in equity, which will focus on the non-controlling interest and the retained profit column. And for this session, we are going to focus on the preparation for acquisition of a subsidiary that take place during the current year, or in other words, that's called the mid-year acquisition. So it is going to be acquisition in the current year, acquisition during the current year. Okay, I will use current year and I'm going to put it as CY. Right. So we have the company. The year end of the company is 31st of December 2017. That is the reporting date. The current financial year end would be that date. And you have two companies, MME and LO. You have the statement of profit or loss separately there shown. And there's also a statement of changes in equity of these two companies, MME and LO Berhad. And you have the additional information that informs you on some acquisition here in number 1. You have information of acquisition of the issued ordinary share. So the holding percentage is 80%, NCI is 20%, and that happens on 1st of July 2017. So if you look at what I just mentioned earlier, 1st of July 17 is the date of acquisition, and you have been informed that the year end is 31st of December 17. So it means that the beginning of the year is 1st of January 17. So the company was acquired here. So this is the date of acquisition. So that was just for 6 months. So the company was acquired. I'm talking about LO, the subsidiary, and MME is the holding company. So holding acquired the subsidiary, not only the ordinary shares, the same acquisition is also for the preference shares. This is for the ordinary shares. For the preference share capital, it was the other way around, 20% and 80% respectively. And both were on the same date, 1st of July. So if that is the case, on this date, you are informed that the retained profit of LO is the subsidiary, was having 22,75950, and you are also informed on the January reserve balance of LO to be here the figure 56.5 million. Okay, that was the information on the date of acquisition. And for that reason, if you have the situation where acquisition is during the current financial year, the consolidation of the revenue and expenses of the subsidiary shall just be for 6 months. Why 6 months? It was between 1st of July up until 31st of December. So that was 6 months. So this will all be a portion according to 6 months. 6 months means during the post-acquisition period in the current year. So if this is the case, post-acquisition period in the current year was 6 months. Yeah, the post-acquisition period, post-period was 6 months. So therefore, there is a pre-period, meaning that in the same year, 6 months earlier, or the first half, was not yet acquired. It was not having a subsidiary parent relationship. So the pre-period was 6 months as well. So whatever transaction that happened here, or the so-called income and expenses that will be consolidated, those of the subsidiary will be those during the post-acquisition period only. And we are also going to take into consideration the intercompany transaction that happens during the post-acquisition period. So that was the issue there. You're informed the issued paid-up capital of LO made up of 100,000 ordinary shares, and it was 1 ringgit each for both, also the preference shares. And you are informed the preference shares is non-redeemable, so they are all equity shares, and these are not liability, so that is not redeemable preference shares. So those are the information. And then number 2, you have the information on fair value adjustment. So you were informed that the fair value of LO, that is the subsidiary company's asset, were equal to their book values. So book values or the carrying value, except for a building which had a fair value of 2 million in excess of its book value, in excess. So meaning that there was a revaluation surplus, and this revaluation surplus happened on the acquisition date, which is on 1st of July 17. So this is actually a pre-acquisition surplus. And the pre-acquisition surplus that was given, pre-revaluation surplus was 2 million. So that 2 million must be incorporated in the fair value of the net asset on the date of acquisition, 1st of July, for the calculation of goodwill, and also for the calculation of the non-controlling interest. You are informed the remaining useful life of the building is 20 years. So of course the surplus may also need to be recorded in the statement of financial position if you are asked to prepare the statement of financial position. The remaining useful life of the building was 20 years. So if that is the case, you also need to make an adjustment for under provision of depreciation, right? One is for the surplus, another one is for the under provision of depreciation, and that under provision of depreciation should be 2 million divided by 20 years. And if you do that, you will have 100,000. And that must be done for the adjustment part of the depreciation, since the asset now is having a fair value which is higher than the carrying value. That was the first one for the adjustment on the fair value. The second adjustment on the fair value is the adjustment for the another asset, which is customer lease. So earlier on, the customer lease was not being recognized. However, on acquisition of a company, the parent company will value the customer's lease that of the subsidiary, and now it has been recognized. It can be recognized because that was through the acquisition or through the purchase of the company. So that was recognized, a customer list now, and the fair value was 15.8 million. So this is actually recognition of unrecognized asset, non-current asset here. So the recognition, it will now be recognized at a fair value of 15.8 million, and this will also be included in the fair value of the net asset on the date of acquisition. That will be included. At the same time, if you can still recall, for the depreciable asset like building, you have depreciation, but this one is for intangible asset. There is no depreciation, but you will have to go and provide amortization charges. So therefore there is some amortization that need to be provided. So there are some amortization charge that you need to do and provide, which would be 15.8 million, and you have a remaining, it was to be amortized over 5 years, so divided by 5, and that will give you a figure of you need to go and calculate that how much is the amortization, and you will get the figure to be the figure, and that has to be also multiplied with, I have to show you another thing here, 6/12. Why? Since the amortization is for just half year. Why half? Since you acquire the subsidiary 1st of July up until 31st of December. That was just for 6 months. So the amortization is only done for 6 months. 15.8 divided by 5 times 6 over 12. And that will give you of 158. For the case of a building, we do not go and amortize and later um, multiply that with 6 over 12 because of this statement here. You have the information depreciation policy of the group is to depreciate all its property on a straight line basis, and you need to give full year the depreciation, right? So therefore it is being charged full year, so it is actually annual basis for item A. But for item number 2, item number 3 is on has to be done according to also post acquisition period. So you have that, and this one is what you need to go and adjust later by debiting your amortization, and that will be in the admin expenses later in the SOPL by that amount, and crediting the so-called customer list. The same thing for under provision. For this one, you are going to also, let me just use a different color for the provision. It is going to be debit depreciation, that will be under admin expenses, and that will be credited to the building. So if you want to know the journal entry, so the amount is 100, right? That was for the second one. Make sure you include that in your adjustment in the admin expenses when you prepare your CSOP. Number 4. Number 4 is relating to goodwill. So you are informed the goodwill, you don't have to calculate. It was 28 million. It was impaired by 10% on 31st of December. This is the impairment on the current financial year, and so you will have to go and debit goodwill. Here is impairment loss. You have already recorded the goodwill. For example, here we are doing the impairment loss of goodwill, and that will be 10%. 10% will be 2.8 million. 28 million times 10%, and credit the goodwill and 2.8. And remember, this will be included in the SOPL, right? You will have to include that in the statement of profit or loss, the consolidated statement of profit or loss, because that has to be done by putting that as an expense, right, of the group. 1st of October, there was an intercompany transaction. Okay, what I would like to remind you is to look closely at when is the date. Here it was on 1st of October. It was during the post acquisition period. So it is somewhere here, 1st of October, during the post acquisition period. So this is an intercompany transaction, since on that date the parent subsidiary relationship has existed, right? So therefore, that is who is the seller. Here the seller is the subsidiary, so this is upstream sale, and the goods sold has to be eliminated, since only 40% of the goods were being sold, so 60% were unsold. For the unsold goods, you need to look at the unsold goods that has to be provided with the unrealized profit provision for unrealized profit. So for the unsold good, it is actually 10% over 110, 10 over 110, because there was a markup, times 60% times 60.5. So you will get the URP. And for the intercompany sales, upstream sales, that is sales to the seller, but it was a purchase to the buyer. So that has to be debited to the cost of sale and debited to the sales and credited to the cost of sale, to remove the intercompany sales and purchase with how much? With 60.5 million, 60.5. So for the unrealized profit, if you have done the calculation correctly, that will give you 3.3 million, 3.3 or 3,300, right? For the unrealized profit, However, for the sales or purchase, that was intra-group sales, intra-group purchase, that was 60.5. Now we go to number 6. We are doing the adjustment first. Then we'll be doing the remaining preparation. Part of the gain on disposal represent gain from sale of motor vehicle to third party. So if you look at the gain of disposal, let us look at the gain of disposal here. Okay, let's go. These are the gain of disposal. You are informed. Part of it represent the one to the third party, and you are informed that 900 here to third party, a sale to the third party of 900. So meaning to say that 900 is to the third party, so this one would be recognized, and the remaining, which is 8.2 million minus 900 remaining, we'll take your calculator then and find how much is that. Remaining will be intercompany gain. So the intercompany gain must be removed. That intercompany gain, if you do that, you should be able to find it was 8.2 million minus 0.9. That was the intercompany gain that must be removed, and it means that only 900,000, yeah, sorry, it was just 900, not 900,000, 900. That should be shown in your consolidated statement of profit or loss as the gain. So we'll be doing that by taking 8.2 minus 0.9. We'll do that in our statement. Next is to remove that. So what we'll do is we're going to remove that debit gain with the amount 8.2 minus 900. Yeah, 900, which is minus 900, 8.2 million minus 900, and you are going to remove that in the equipment also with the same amount. That was to remove. Here is the information telling that the dividends has been paid during December, somewhere in December. So those are all telling you dividends are post acquisition because it was declared right after the date of acquisition, 1st of July. After a few months, the dividend has been declared. So you as the parent will have the share of the dividend, and that has been already been included or had received its share of dividend from the investee company. So for number 7, so the dividend is normally included in the investment income. So in this amount of dividend here, you can see the amount of dividend here. This one is not the one. The one here, 7.8 million. It also includes some intra-group dividends coming from ordinary dividend and also from preference dividend. And that intra-group dividend must be removed. So that has to be done. And what we will do is for that part, for number 7, I'm doing it here. You are going to debit the investment income because that included those intra-group dividend. We have to remove, so we debit, and we will credit our dividend receivable because earlier on we debit the dividend receivable. Yeah, that has by right should be shown in the statement of financial position, and that dividend receivable must include, one is the share of the parent, and when you can see here dividend that was being declared, you can check here the one declared by the subsidiary. Ordinary dividend was 6,005. Out of that 6.5 million, right? 6.5 million. You have a share of 80% that must be excluded. And again, out of the 1.2.5 million, 1.2.5 million, 1.25 million, right? That 20% is the share of the parent in the preference dividend. So these two will bring up to a figure of intercompany dividend. This is going to be 5,200 here, and this is going to be, if you take your calculator, 250. So that would be the total would be, here would be, you need to go and check how much is it, yeah, how much is the amount. I've not we have to go and finalize this amount here. We have to check that 1.25 times 20%, how much is the amount of dividend. Right, after you have done that, you will now include that in the statement. We remove them here. You need to go and calculate and remove them. This one is just a statement saying that the profit or loss has accrued evenly. Number 10 is information telling you about the valuation of the non-controlling interest, which is at the proportionate share of the fair value of the net asset on the date of acquisition. And that was the case. So we are going to answer part B. We're not going to answer the theory part, just the calculation part here, right? Okay, so let's do that in our consolidated statement of profit or loss that I've already prepared here. So let me just rephrase again that when you have acquisition of the subsidiary during the current year, the post-acquisition period really matters. So for the parent, what you will do is you will have to um, consolidate, of course, in full the amount, but for the subsidiary, you are going to just show the amount that is during the post-acquisition period. So the sales, for example, will have to be reflected. So I put the amount here first, but I'm going to show the sales. Revenue would be the one of the parent plus only 6 month sales of the subsidiary, that was from 1st of July up until 31st of June. And be careful, you must also eliminate the intercompany sales of 60.5 million. That was information number 5. Go and check information number 5 again, and that will give you 1.122 and 0.5 million. Right, that was the answer. Next is what you would have for the cost of sales. The cost of sales, the cost of sales would be, so let me just add one thing here. It should be million here. Make sure you do include that in yours, right? So cost of sale, as I mentioned, you need to do the same for this. Okay, and that would be the amount that you consolidate would be for 6 months of the subsidiary, and the one here that you have would be intercompany purchase that you remove, right? And again, you also have to do that for the unrealized profit. So unrealized profit, another item, 3,300. Okay, so you can see all the blue figures there, and same goes for the intercompany sales, right? So that will give you the cost of sale adjusted figure, and that adjusted figure is 319,800, 319,800, which is actually to the million there, 319.8 million, right? So you have your cost of sales now. This is your cost of sales, and now you have your gross profit. Next is to focus on the next item, which is the one that was other income. In your statement of statement of profit or loss, you have this item. So we're just following this only. We're going to now look at the gain on disposal. Remember earlier on, for the gain on disposal, information 6 has mentioned about this. The gain on disposal include also amount to the third party. So the amount to the third party, 900, must be included there, but the one that must be removed is the one which are from the group members. So we'll be doing that here. First, just show what you have, which is here nothing. But here you would have to include and remove the intercompany disposal, which is 8.2 million minus 900, minus 900, I put here 900, RM 900, right? And that would give you 8.199.1 million. So therefore you remove the intercompany transaction, and that will give you a figure of only 0.9, which is your information for your gain on disposal. Next, so we will continue with the next video in our next with our second session in our next video. I will proceed with that. Until then, I'll see you in the next video.